Hello there, and thanks for joining me for a wee chat. I'm really glad you're here, because today we're diving into something that matters to all of us. What to do with the money you've worked so hard to earn. Life's moving fast, isn't it? Between work, family, and everything else, it's easy to put off thinking about the future. Whether that's planning for retirement, helping your loved ones, or maybe even finally getting that dream cottage by the sea you've always imagined. But at the heart of all those dreams, there's one thing in common: money. It's the foundation that can help turn your hopes into reality. You've worked hard for every penny, and having a lump sum like £20,000 is a real achievement. It's not easy to save that much, and you should feel proud of what you've accomplished. The big question is, what now? What's the smartest thing to do with that money so it can help you reach your goals? It's tempting to just leave it sitting in a savings account where it feels safe and familiar. But is that really the best move for your future? I want to show you how to make your money work harder for you, so it grows and supports your dreams down the line. There are more options than you might think. Finance can seem confusing, even overwhelming at times, but don't worry, I'll break it down into simple, easy-to-follow steps so you feel confident every step of the way. Together, we'll explore how to give your £20,000 the best chance to grow without taking wild risks or losing sleep at night. So, grab a cuppa, get comfy, and let's have a friendly, honest talk about making your money truly flourish for the future you deserve. Saving for a rainy day is always a wise move, and it's something many of us were taught from a young age. Having a little extra tucked away can help us feel secure when life throws us a curveball. But when it comes to bigger, long-term goals, like buying a home, funding your children's education, or planning for retirement, a standard bank account might not be enough anymore. The interest rates are often so low, your money barely grows at all. Inflation is the silent thief in the background, slowly eroding your purchasing power. Over time, your money buys less and less if it isn't growing faster than the cost of living. For example, if your savings earn just 1% interest, but inflation is running at 3%, you're actually losing value every year, even if your balance looks the same. Imagine you have £20,000 sitting in your account for 10 years. If it just sits there, its real value will shrink, and you'll be able to buy less with it in the future. The cost of holidays, homes, and even everyday groceries will keep rising, but your savings might not keep pace, leaving you with less financial freedom. That's why it's so important to think differently when it comes to long-term money. We need to plan ahead and make our money work harder for us. Of course, emergency funds should always be kept in cash, ready for when you need them at a moment's notice. But the money you know you won't need for several years deserves a chance to grow and outpace inflation, so it can support your future dreams. The goal isn't just to keep up with inflation, but to beat it, so your savings grow in real terms, not just on paper. This is where investing comes in. By putting your money to work, you can turn your nest egg into a golden goose, helping you achieve the future you've always imagined. So, saving alone isn't enough to build real wealth over time. What's the alternative? That's where investing comes in, a powerful tool for growing your money beyond what a simple savings account can offer. Saving is all about safety and security. Your money sits in the bank, protected and earning a little interest. It's a great way to build an emergency fund or set aside cash for short-term needs. Investing, on the other hand, is about seeking growth, putting your money into things like shares, bonds, or funds with the aim of earning higher returns over time. With saving, The risk is low and your money is stable. With investing, there's always a chance your money can go down as well as up, especially in the short term. The trade-off is clear. Higher potential returns from investing mean accepting some risk and volatility along the way. That's why you should only invest money you can leave untouched for several years, giving it time to grow and recover from any market dips. Don't let the word risk scare you. Long-term investing gives your money the chance to bounce back from bumps in the road, and history shows that markets tend to recover and grow over time. Markets rise and fall, but if you look at the bigger picture over decades, the overall trend is upward, rewarding patient investors. Saving is best for short-term security and quick access to cash. Investing is designed for long-term growth and building wealth for your future. Both saving and investing have an important place in your financial plan, working together to help you feel secure now and build for tomorrow. Next, let's focus on how investing can help you reach your biggest financial goals and dreams. Now, let's talk about the Stocks and Shares ISA, the perfect tool to start investing. An ISA is a tax wrapper. Anything inside is sheltered from income and capital gains tax. That means all your investment growth stays yours. Each tax year, you can put up to £20,000 into ISAs. Use it or lose it. Your allowance doesn't roll over. A Stocks and Shares ISA isn't an investment itself, but an account that holds your investments tax-free. You choose a provider, open the account, and pick your investments. It's the most popular way in the UK to start investing, and for good reason. Let's get practical. How do you open a Stocks and Shares ISA? First, choose a provider high street banks or online platforms like Vanguard or AJ Bell. Compare fees, investment choices, and user friendliness. Opening an account is usually quick and online. Transfer your £20,000 in, now it's protected by the ISA wrapper. You don't have to invest it all at once. It can sit as cash until you're ready. Next, choose your investments. Most beginners start with funds. A fund is a basket of investments, spreading your risk. By buying into a fund, you own a slice of many companies or assets. You're in control, but you don't have to pick individual shares. Now, your money's ready to invest. Let's talk about diversification. Don't put all your eggs in one basket. Investing everything in one company is risky. Spreading it across many is safer. Funds make this easy, pooling money to buy a wide range of assets. For example, a global equity fund invests in hundreds of companies worldwide. If some do badly, others can balance it out. Funds are often labeled by risk, cautious, balanced, or adventurous. Beginners often start with balanced or growth funds for steady, long-term growth. Many platforms offer ready-made portfolios. Just answer a few questions, and they suggest a fund. Instant diversification, managed by experts, is a great way to start. It gives you peace of mind as a new investor. Let's face it, seeing your investments drop in value is scary. But market ups and downs are normal. The worst thing you can do is panic and sell when prices fall. That locks in losses. Staying invested gives your money a chance to recover. History shows markets bounce back and grow over time. Think of downturns as sales. If you can, buy more at lower prices. If not, just hold on and ride out the storm. Only invest money you won't need for at least 5 years. A long time horizon is your superpower. Short-term dips matter less. Stick to your plan, ignore the noise, and let your investments grow. Ups and downs are part of the journey. Patience pays off. You don't need to be an expert, but a little research builds confidence. Use your platform's educational resources, articles, videos, guides. Check the Key Investor Information Document, KIID, for any fund you consider. It explains what the fund invests in, its goals, risk level, and charges. Read independent sites like Money Saving Expert for impartial advice. Avoid anyone promising guaranteed high returns. If it sounds too good to be true, it probably is. Stick to reputable sources and take your time. If you want tailored advice, consider an independent financial advisor. For most, a simple, ready-made fund is a great start. The key is to start. Knowledge and action go hand in hand. We've covered why saving alone isn't enough and how investing through a stocks and shares ISA can help your money grow. Your £20,000 is a powerful starting point for your future. Remember, investing is for the long term, and diversification is your best friend. Funds make it easy to spread risk, and the ISA keeps your growth tax-free. Don't let fear hold you back. The biggest risk is doing nothing. Start simple, learn as you go, and build confidence over time. Imagine looking back in 10 years, glad you took control. Investing isn't just for experts, it's for everyone, including you. Take that first step today. Your future self will thank you. Good luck and happy investing.